This presentation is for Chapter 4, Part 1, Statement of Cash Flows. This slide shows information from the Statement of Cash Flows for Lehman Brothers Holdings, Inc. for the years ending November 30th, 2007, 2006, and 2005. The company was reporting positive net income for each of the years but failed to produce positive cash flows from operations in any of the years. As the information shows, the company was borrowing heavily to cover the cash deficit from operations. It subsequently filed for bankruptcy in 2008. Lehman Brothers is just one of many examples of companies that reported positive net income but negative cash flows from operations. By examining the statement of cash flows, it is possible to spot problems with companies that are unable to generate the needed cash to fund operations and also pay back their creditors. Positive net income is good, but ultimately the company will go bankrupt without sufficient cash generated from operations. The importance of the statement of cash flows in analyzing the health of a company cannot be underestimated. The inflows and outflows during the accounting period, especially over time, is an extremely important analytical tool that should be used by all analysts. The cash flow on the statement are segregated into three categories: operating, investing, and financing activities. The statement of cash flows provides the analyst with information on the changes in the balance sheet accounts from one period to the next. This is important for the analyst because accrual basis accounting allows for many estimates that can significantly affect net income and hide problems that may be occurring. Ultimately, the change in the cash and cash equivalents from the beginning to the end of the accounting period are explained through the statement of cash flows. Each of the balance sheet accounts is represented in the operating, investing, and financing activities sections and is reconciled with the change in cash over the accounting period. This schedule for Lehman Brothers for the November 30th, 2007 year end shows the small increase in the cash account was largely the result of the financing, which was driving the company deeper and deeper into debt, ultimately ending in the filing of bankruptcy in 2008. Cash increased by $1.299 million, but there were negative cash flows from operations in the amount of $45.945 million, as well as negative cash flows from investing of $1.698 million. The financing inflows of $48.592 million were being used to prop up the company and cover the cash deficit. However, this situation was not sustainable for Lehman Brothers or for any other company for that matter. In order to understand the analysis of the statement of cash flows, you must first understand how the statement is prepared. First, you must have comparative balance sheets for two periods or from the beginning to the end of the accounting period. This information is used to determine the changes in the balance sheet accounts over time rather than just the ending balances. This illustration shows the sources of inflows and outflows for the statement of cash flows from operating, investing, and financing activities. The total inflows less the total outflows will equal the change in cash for the accounting period. This is the statement of cash flows for Sage Inc. for the periods ending December 31st, 2016, 2015, and 2014. These statements were prepared using the indirect method. The statement of cash flows has four parts or sections: the reconciliation of cash from the beginning to the end of the period, and the cash inflows and outflows separated into operating, investing, and financing activities sections. Cash includes not only cash on hand and deposits in the bank, but also highly liquid short-term marketable securities. Some examples of cash equivalents include U.S. Treasury bills, certificates, notes, bonds, and commercial paper. Some companies will separate their marketable securities into two categories: cash and cash equivalents and short-term investments. If they do this, the short-term investments are included under investing activities. The operating activity cash flows are those that are involved in delivering or producing the goods or services that the company provides to customers, and the cash effects of these transactions and other events that enter into the determination of net income. The investing activities are those involved in acquiring, selling, or otherwise disposing of securities that are not cash equivalents and productive assets that are expected to benefit the firm for long periods of time. They also include the lending and collection of loans to others. The financing activities include borrowing from creditors and repaying the principal, as well as obtaining resources from owners and providing them with a return on their investment. The first step in preparing the statement of cash flows is to calculate the changes in the balance sheet accounts for the period. These increases or decreases will be used in one of the three categories of the statement of cash flows, depending on whether they are involved in operating, investing, or financing activities. After the totals for each of the categories are determined, they sum to the change in cash for the period. This illustration shows the calculations of the change in each of the balance sheet accounts for Sage Inc. from the beginning to the end of 2016. The category of the statement of cash flows for each of the accounts is shown beside the change and is helpful in preparing the statement. After determining the change in the balance sheet accounts for the period, the next step is to transfer these to the appropriate area in the statement of cash flows. It is important to determine whether the change is considered an outflow or an inflow of cash. This slide shows the changes in the balance sheet accounts and what is considered to be an inflow or an outflow. Decreases in assets and increases in liabilities and equity accounts are inflows. Increases in assets and decreases in liabilities and equity accounts are outflows. This comparative balance sheet includes the changes, and we can see that most of the current assets and liabilities are associated with operating activities. The long-term assets and property, plant, and equipment are involved with investing activities, and the long-term liabilities and equity accounts are associated with financing activities. The cash inflows for Sage Inc. will come from the decreases in the other assets, increases in long-term debt, common stock, and additional paid-in capital accounts. Outflows of cash came from increases in inventories and decreases in notes payable. The accumulated depreciation account is a contra asset account and is used to reduce the property, plant, and equipment to book value. On the statement of cash flows, the change is included in the operating activities, and increases are added back to net income as increases in liabilities are added back. Because there may be multiple transactions affecting individual accounts, it is important to analyze the changes within the investing and financing accounts because inflows and outflows must be shown separately instead of being netted. The cash flows from operations are important because they represent the cash that is generated internally from the operations of the company. The investing and financing activities represent cash that is obtained from external sources. There are two methods for presenting the cash flows from operating activities, the direct and the indirect methods. Regardless of the method used, the cash inflows from operating activities will be the same. The direct method lists the cash flows under specific categories: the cash collected from customers, interest and dividends received, as well as other cash receipts are the inflows. The cash paid to suppliers for interest, taxes, or other operating expenses are the outflows. The indirect method begins with net income and adjusts for the accruals and deferrals required under accrual basis accounting, as well as non-cash and non-operating items. This is an illustration of the operating activities section of the statement of cash flows for Sage Inc. for December 31st, 2016 using the indirect method. This exhibit includes many of the adjustments made to net income to arrive at net cash flows from operating activities. Note that the first category is the non-cash, non-operating adjustments to net income, and the second category is the change in the current assets and liabilities that were calculated on the comparative balance sheet worksheet we reviewed previously. This is the desired format for the operating activities section. For Sage Inc., net income was first adjusted for the non-cash depreciation and amortization charges included in net income, followed by the change in the deferred tax liability account, which is also a non-cash expense. Next, the increases in the accounts receivable and inventory accounts are deducted. The decrease in prepaid expenses is added, as well as the increase in accounts payable. The decrease in accrued liabilities is subtracted, and the increase in income taxes payable is added. The increases and decreases in these current assets and liabilities represent accrual basis entries that do not represent the use or provision of cash, but entered into the calculation of net income. When analyzing the property, plant, and equipment and other asset accounts for the investing section, there was an outflow of cash for additions to property, plant, and equipment of $14.1 million and an inflow for the decrease in other assets of $295,000. The financing activities for Sage included an inflow of $256,000 from the issuance of new shares of stock during 2016. There was also an outflow from the payment of short-term debt of $398,000 and an inflow of current maturities of long-term debt in the amount of $368,000 for a net outflow of $30,000. The long-term borrowings of Sage Inc. should be segregated into the inflows, additions, and outflows, reductions, for purposes of presentation on the statement of cash flows. The 2016 inflows or additions of $5.6 million and the outflows or reductions of $1.516 million are shown separately to arrive at the net inflows of $4.084 million for the year. The change in retained earnings should also be segregated into the additions for net income and the reductions for net losses and dividends. It is important to note that the dividends paid affect cash rather than the dividends declared. Therefore, only the dividends actually paid are shown on the statement of cash flows under financing activities. This illustration shows that Sage Inc. had net income of $9.394 million and dividends paid of $1.582 million for 2016, resulting in a change in retained earnings of $7.812 million for the period. The last item on the statement of cash flows is the net increase or decrease in cash. This is arrived by summing the cash provided or used by operating, investing, and financing activities. In this case, Sage Inc. had a net decrease in cash and cash equivalents for 2016 of $1.053 million. This amount should equal the change on the comparative balance sheet for the year. Each company will have its own strategy for operations that will affect the cash flows provided or used in operations, investments, and finances. It is important to understand the company's strategy as well as its success in implementing the strategy over time. Comparing two companies such as Walmart Stores Inc. and Active Power Inc. shows the differences in the company's statements of cash flows. Walmart is generating enough cash from operations to easily provide for the investing and financing activities of the company and increase the cash balance for the year. However, Active Power Inc. did not generate enough operating or investing cash flows, so the company had to generate cash from financing activities to increase the cash balance. This is the end of Chapter 4, Part 1, Statement of Cash Flows.